please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Results season is upon us again. This quarter has the advantage of the low base of the demonetization quarter year ago, but it also has the disadvantage of some continued GST adjustment and, of course, weakness in corporate banks. Hello and welcome to our special earnings season curtain raiser, Quarter Se Quarter Tak. I'm Lata Venkatesh, with me, Prashant Nair.
Hi, Lata. It's not just me, but and rather us, but the entire research team will pitch in with, of course, sectoral insights. Our three experts who know the numbers like the back of their hand: Nishchal Maheshwari of Edelweiss, Sanjeev Bhasin of IIFL, and Gautam Duggar of Motilal Oswal. Gentlemen, all of you, thanks very much for being with us here on the show today.
Okay, well, for starters, let me just, before I go to the guests, tell you what are likely to be the key things that we should watch out for in the current quarter itself. It's going to be another desultory quarter. We are not getting that long-awaited double-digit growth. We understand from experts, Sensex earnings maximum 9.5% or thereabouts, and Nifty earnings a max of about 7%. Negatives, this would be the seventh consecutive year of single-digit earnings growth, and this is a single-digit growth despite an advantageous base. That is, last year, 2 quarters were affected by demonetization. Even then, we are not able to generate double-digit growth. It's a bit of a negative, but the positive, of course, is that definitely companies are talking to us about rural consumption. Consumption companies are talking to us about capex. There is early signs, and of course, now it does look like we are on the verge of double-digit growth in FY19. Let's hope it's 20%. At the moment, that looks ambitious. But anything sectorally that you can point out?
Just very broadly putting companies into buckets where, I mean, there could be potential winners and potential losers. And when we say winners and losers, it's both in the relative sense. I mean, result season is always about what comes and what is expected, but also disappointment in the absolute sense in sectors where there is no recovery, or maybe the strong performance continues. So it's both relative and absolute. These are the potential winners. First up, to start with, autos and consumer goods. I mean, those are two sectors which have been strong now for quarters on end. So strong sort of performance expected there. Industrials. I mean, we've been discussing now for the last couple of weeks the fact that things may seem to be picking up, and it's got the advantage of low base. Metals. I mean, across the board, price increases have continued, so results should be multi-quarter high or all-time high results from the metal sector. Potential losers, on the other hand, I mean, some of the known suspects. So telecom, again, no real reason for any recovery. IT, I think one will have to sort of watch closely because stocks have run up quite a bit. So if results disappoint, what will happen? Real estate, there is no real big recovery, at least on the residential side. Pharmaceuticals, I mean, troubled space. Stocks are beaten down. Infrastructure and media are the other two areas which will be potential losers as far as this result season is concerned. Lata.
Okay, well, so that's a fair number, equal number of winners and losers. Let's invite our guests. First up, Nishchal, what can be a wild card in this result season? I read all your reports, and it looks like nobody is going with a double digit. The maximum I saw was, I think, Sensex 9.7% from one of the research houses. Do you think there can be some wild card which can give us an extremely good number?
So, Lata, I think at the face of it, doesn't seem to be that there is going to be any kind of a wild card in the current quarter. I think the sectors which are supposed to do well are pretty well defined. I think commodities is going to do well, basically both on the oil side as well as on the metals. The FMCG, the consumers, autos, I think these are 3-4 sectors which will continue to do well. As far as I think the sectors which are not expected to do well, domestic investment, exports, especially pharma, and PSU banks and telecom. I think these are the sectors basically which will disappoint the market. So, but I think these are things which are pretty well known, and I think is baked into the prices. Don't see any wild card entries in this quarter.
Gautam, what is your sense? I mean, a brief comment on the results itself, top down, and more importantly, how is the market set up? Is it set up constructively to react to what you expect in terms of numbers, or it's set up for disappointment?
I think after the correction that we've had in the last 2 months, the market is not very frothy, especially at the mid-cap level now. After the good correction, we have seen individual stocks correcting 20-30%. Secondly, in the last 2 weeks, RBI has given a lot of benign news flow, whether it is pertaining to revising down the inflation expectation, which then played its part in the bond yields going down. They've also reduced the requirement for provisioning for bond losses for the quarter. So all of that put together has meant that bond yields have come off almost 70 basis points, which obviously at the margin is helpful for valuations. So correction plus some improvement in macro. I think a lot of high frequency data that one is getting on consumption side is pointing towards underlying demand revival. So I think market is not very precariously poised, I would think. Secondly, in terms of numbers, we are expecting around double-digit earnings growth. So we are expecting 11% for our universe and around 13 to 14% for Nifty earnings growth. Again, I must also hasten to add that for our universe, the base is not weak. In fact, when I look at my own universe, the base quarter had a 24% earnings growth, because in the base quarter, the losses for PSU Bank had reduced substantially from 4Q FY16 to 17, and metals profit had gone up substantially again. So base is not as low for my universe when I add up all the sectors together. But if I leave aside metals and PSU Bank, then the base quarter had just 3% earnings growth for our universe, and on that we're expecting 11%. So whichever way I look at it, I'm getting around 10-11% kind of an earnings growth. And as Lata was mentioning in the beginning, within the broad spectrum of sectors, again, consumption is looking extremely good. Autos will have a blockbuster quarter. NBFC will continue to have another strong quarter. We're expecting strong performance in consumption. We're expecting commodity space to do well, both metals and oil and gas, and in fact utilities also, given that Coal India is expected to do well. So for our universe, and for broadly, I think even for Nifty for that matter, cyclicals is what we expect will drive the earnings. In fact, we are expecting 2/3 of the earnings, almost 65% of the incremental earnings, to come from global cyclicals, which is metal, oil and gas, and Coal India. And the way we categorize our set of stocks, even defensives after 5 quarters of consecutive YOY profit decline, is expected to report a modest profit growth, and this is largely coming on the back of IT sector doing well. In fact, we are expecting double-digit profit growth for IT sector after 8 quarters of sluggish performance. So it's a glass half full kind of a picture, and given that markets have had a correction, you still have enough bottoms up opportunities, and obviously it sets up a very strong ground for the next year.
Okay. Oh, Gautam, that's a very comprehensive reply. So let's quickly get to Sanjeeva. Sanjeeva, a very quick question, because we have a lot of sectors to cover. Even now, when I look at all even after this very positive analysis from Gautam, and I look at all the forecasts, the forecasts for FY19 are almost 20 to 25%. Are we setting up for a disappointment there?
Correct. So it has to be stock sector specific, and you've seen a lot of green shoots, Lata. I won't take too much time, but 3 stocks which have been where the guidance and the managements have been very, very confident of execution. Thermax on the manufacturing side, which tells you that boilers and the Middle East market has been the best they've seen in 18 quarters. Shobha Developers on the real estate side, which is giving you very, very strong numbers on execution after RERA. And thirdly, NBCC, where again they've guided for at least a 35% growth in this year, FY18-19, and on a quarter to quarter they are very, very bullish. So like I said, it will be execution, but I think you should be pleasantly surprised on construction and manufacturing, where the base has been low and where the tidings have been negative. So I am not so pessimistic. I think we are mostly being driven now because of the gloom and doom of the market correcting 2 months. I would actually think 10 to 12% is something where the Nifty growth could be there, and the guidance could be very, very positive going forward.
Okay, Sanjeev has also identified 3 names, Zoba, NBCC and Thermax. Sanjeev, thanks for that. With that, we begin our sort of sectoral survey. And we start with, of course, the IT sector, as always, the first big sector to come out with results. Let's go across to Rima, who's standing by with essentially a quick preview, snapshot of the sector. Rima, over to you.
Well, the IT sector has been an outperformer. The IT index has outperformed the Nifty by 12% in this Jan to March period. So the street is watching, will the reality match up to the expectations as well as the hype? Now, Q4 is a seasonally weak quarter, but this Q4 will be better than last year, aided by cross-currency tailwind, largely on account of the dollar depreciation. The key, as always, will be Infosys guidance for FY19. Constant currency growth will be seen at 6 to 8%, with margins maintained at 23 to 28%. For TCS, the deal wins have been robust in the quarter gone by, but the management has sounded a bit skittish on BFSI, so a pickup there. For Wipro, the Q1 guidance and a pickup to the industry growth rate. For HCL Technology, it will be the guidance. In terms of demand commentary, will FY19 be a year of accelerated growth? Will all the leaders talk about an improvement in BFSI, considering it's the biggest contributor to growth? And is there scope for a margin improvement from here on, given most of them are operating at peak utilizations?
Okay, thanks for that, Rima. Let me also get the banking sector analysis and then go to our guest. Abhishek, tell us, how does the banking sector look?
In the banking sector, the loan growth has picked up to about 11% at the end of FY18. However, due to RBI's recent notice that had come in on 12th of February, slippages can be on the higher side. That can cause an impact on the net interest income, as your earning interest will be on the lower side. Some respite can be seen on the mark-to-market portfolio because of the fall in yields. So that can provide some cushion. However, the corporate-facing private banks can see an elevated provisions owing to the stress in the corporate sector. So overall, weak set of earnings expected by the analysts in terms of banks because of lower NII growth, muted other income growth, and elevated provisions on the corporate-facing banks, especially on ICICI Bank and Axis Bank. Kotak Securities expect a 95 to 97% decline on their YOY profits.
All right, thank you, Abhishek, for a very, very quick snapshot. Let me get to Nishchal. Nishchal, any preference within the IT space itself, say mid-caps over big caps, who will do better?
So we continue to like the large caps, given that the valuations on the large cap IT is still much interesting. 2 topics out there are Infosys and Tech Mahindra in that order. And in the mid-cap space, we like Persistent. But we definitely like the large caps over the mid caps.
Gautam, same question to you. Let's wrap up banks first. What's your sense, and which could be the winners there?
Banks, you're saying?
Yeah, banks, yes.
So I think banks, there's very little to choose between retail-oriented and corporate-oriented private banks. Preference continues to remain with retail private banks. In fact, in our model portfolio, we've introduced IndusInd Bank, we've replaced Federal with IndusInd, and we have reduced the overweight of ICICI Bank marginally and added that to the other retail-oriented private banks. I think the real game in financials is happening in NBFCs, where there is going to be another quarter of 30% plus growth, and this has been like the 8th or 9th consecutive quarter where the earnings growth has been extremely steady, and it's very broad-based. I think barring LIC Housing Finance, we're expecting very strong performance across the board. And with bond yield softening, you will find significant interest coming in that space. We've replaced HDFC Life in our portfolio with Bajaj Finance to indicate that bias for us.
Okay. Well, actually, we will ask you all about NBFCs in a bit. But before we wrap up this segment, Sanjeev, is it the catharsis over for corporate lenders? Have they been beaten black and blue enough? Are all the NPAs recognized? Time to buy?
Correct, and I think if you just go by SBI's number, they had a huge mark-to-market, which the chairman already indicated that most of the pain is over, and now I think RBI's relief would actually see a part of that being a write back. So, you'll have to be stock specific. I think Bank of Baroda and Indian Bank on the PSU lenders can surprise pleasantly on the upside. And like you pointed out, on the private side, I continue to think HDFC Bank and IndusInd, given that the CV cycle is very strong, you've seen that in the numbers of Ashok Leyland, you've seen that in the numbers of Tata Motors, those could be the outperformers. However, like I said, we'll have to see how the books play out for ICICI and Axis, and given the negative rhetoric, I think the price correction has been an opportunity to buy.
So we got through a couple of sectors in the last segment, IT and banks. Let's take a look at what we can expect from the bellwether FMCG sector this quarter. Mangalam Malu, who tracks the space, is standing by with a quick snapshot preview. Mangalam, over to you.
Well, for FMCG, it's a quarter of sustained, or rather hope of sustained recovery, though analysis would be a little difficult given the jarred nature of this quarter. 1 quarter after demonetization, 1 quarter before GST was a base quarter, 4th quarter FY17. But by and large, the sector is likely to see mid to single-digit volume growth. Watch out for improved offtake after November because of the additional cuts seen post-GST revision. And margins may expand for the food companies, benign food costs. However, they may be contained for the home and personal care companies given higher crude and crude derivative prices. For HUL, Dabur, Imami, Bajaj Corp, volume growth between 5 to 8% is expected. Britannia likely to outperform with a gain of almost 9 to 10% on the volume front. But remember, all of this will also be viewed with the management's commentary and the sector valuations, which are at record highs.
All right, stay on Mangalam. Let me invite Nimesh to tell us what to expect from the auto sector.
For auto and auto components, expect Q4 to be a very strong quarter, aided by low base because of the demand effect same quarter last year. In fact, the street is penciling in 22% PAT growth, and if you remove Tata Motors, then the PAT growth is expected to be 28%, which will be the highest in the last 8 quarters. In fact, Tata Motors and Maruti will roughly contribute close to 52% of the total profit pool in Q4. In terms of things to watch out for the demand outlook in FY19. Watch out for margin pressures because of commodity price hike, and watch out for the new product launches pipeline. In terms of auto components, Street is expecting a very strong quarter for companies like Motherson Sumi, Apollo Tyres and Bharat Forge.
Nimish, thanks very much. Anisha is now standing by with a quick check of what to expect from the capital goods and roads sector. Anisha.
Well, Q4 is seasonally strong for industrials and road players, and that should play out this quarter. We are looking at a 15 to 20% top line growth. Order inflow has been strong when it comes to the road players as well as T&D players, but not too strong for defense and oil and gas and other allied sectors. In terms of the companies, for L&T, we are looking at a top line growth of around 10%. Order inflow should not be a worry given Q3 was strong, and Q4 has also seen a systematic inflow as far as order inflows is concerned. For Adani Ports, we are looking at a port volume growth of around 5%. Tepid because coal volumes have been a bit muted given there was not much coal imported from Mundra power plant. However, container is expected to remain steady. Bottom line, of course, the growth will be limited because the company has now a higher tax incidence. Similar is the case with Dilip Bilkon. Now, while the top line growth is expected to be very strong at 20 to 30%, higher tax incidence is expected to limit the bottom line. Other than that, the order inflows have been strong and the company has been beating its revenue guidance as well as the order inflow guidance, and that is expected to pan out this time as well. Back to you.
All right. Well, we have to be quick. Gautam, anything in the infra space that you like? I mean, capital goods and roads?
Yeah, clearly we've just come out with a big thematic report outlining our thesis of industrial capex recovery. We like Thermax over there, best play on industrial capex recovery. L&T continues to find mention in our model portfolio, and as your correspondent was mentioning, roads companies are having a dream run actually in terms of order book, in terms of execution, in terms of the strength of execution that they are doing. So I think roads remains very strong, just that the stocks have run up. So that basically is our view.
Nishal, I mean, your sense briefly on this space, the infrastructure space?
So we have been very positive on this space and we continue to remain very, very positive given that the order books have been record. Actually, we look at in the last quarter and the kind of orders which have come out from NHAI, is at record. More than 50,000 crores of orders were actually given out. Again, in the next quarter, another 50 to 80,000 crores worth of orders are pending basically, which will be given out again in the coming quarter. So I think road companies are doing extremely well. But this is not road alone basically. If you look at Larsen Toubro or other companies, I think they are getting orders from everywhere. But largely this capex has been driven by the government.
Okay.
And we continue to believe that the earnings as well as the order books are going to be very strong for these companies in at least for the next 2 to 3 years.
Okay. Okay. Well, FMCG, Sanjeev, you know, any company I touch is like, 45 times, etc. I mean, I'm of course going trailing. Do you think even if the numbers come good, as Mangalam says they will, they're worth buying?
Well, that's why for us the top pick for this year would be ITC. It trades at 27, 28 times, and you're not factoring in the positivity on a host of other businesses aside from FMCG and cigarettes. You're talking of hotel, you're talking of paper, you're talking of Will's Lifestyle, the apparel, and you're talking of the milk and the other, ITC Haryali. So I think ITC is a no-brainer. I could surprise all the pundits on the upside. HUL, like you said, will be expensive, but on the personal care, that seems to be one of the best plays. And thirdly would be Dabur. But Lata, the real icing here would be on on the consumer beverages side, where Nestle, Tata Global, and Jubilant could actually outperform on the upside.
Oh, that's a tasty idea.
Oh, okay, let's go to autos now. And I think Gautam earlier mentioned briefly that they're going to have a blockbuster quarter. Gautam, volume growth has been pretty strong. Margins, you think, would keep pace?
Yes, I think volume growth has been strong across the board. Two-wheeler, three-wheeler, and of course CV cycle has been on a tear. So that plus the mix improvement also, coupled with the operating leverage, should ensure that there should be a YOY margin expansion. In fact, for our universe excluding JLR, we are expecting a margin expansion upwards of 60-70 basis points on a YOY basis. But clearly, I mean, if somebody wants to play a consumption recovery theme and is scared of FMCG valuation multiples, then I think auto is a better way of playing the same theme. You get more bang for buck here. Also on the rural side, where things like M&M, Maruti, those things can continue to do very well. We are expecting very strong performance from M&M, Maruti. We're expecting strong performance even from Hero for this quarter. So auto, I think, will have one of the strongest quarters in this season.
Okay, quickly, Nischal, across FMCG and auto, what or who will you watch?
So I think FMCG, our top pick, continues to remain as lever basically, and it's a good play on the expected good monsoons. So it's a good rural play, and we continue to like that stock. In case of autos, we have been very positive on the CV cycle, and our top pick out there is Ashok Leyland. I think after the first 2 months of disappointing numbers, I think the last month number was very, very strong for the CV sales. And given the strong outlook and the growth on the IP side, I believe that is a stock one should be having in its portfolio.
It is time we took a look at what you can expect from the oil and gas space. Sonal Butra first to tell us those numbers. Sonal.
Well, few things to keep in mind is that Brent has risen 9% sequentially and is up 24% year on year. Singapore GRMs are at $7 per barrel, which is down 3% sequentially. For the big boy Reliance Industries, we are expecting GRMs of around $11.1 per barrel. That will be driven by strong performance in its petchem segment. For IOCL, we look out for inventory gain, which is expected at around $2.5 per barrel. In terms of $2.5 per barrel, in terms of BPCL, throughput is expected to go higher by 6% sequentially, but that is expected to be flattish for HPCL. Talking about gas production, domestic gas production has risen by 2.5% in 11 months FY18. That will augur well for ONGC, where we are expecting 4% rise in the gas production. For GAIL, we are expecting strong transmission volumes because of higher realizations and low feedstock prices. City gas distribution stocks are expected to do well. For IGL, we are expecting CNG volumes to go up by 10%, and same for Gujarat Gas, expect 10% growth in volumes YOY. So it looks good for these companies this time around.
Okay, so that is oil and gas. Sonal, thanks very much for that. Next, we focus on the pharmaceutical space. I mean, pharma has broadly been divided between India-focused businesses and companies which are predominantly dependent on US. Will that distinction play out this quarter as well? Ekta is here to tell us that. Ekta, over to you.
Well, it's expected to be another muted quarter for pharmaceutical companies in Q4 of FY18. Now, for the US markets, it's expected to decline for the 5th consecutive quarter, with a decline of around 1 to 3% on a year-on-year basis, primarily due to the pricing pressure which continues to plague the US markets. However, some companies such as Cadila and Natco are likely to benefit from a strong flu season and the drugs such as Tamiflu that they're selling in the US markets. Domestic markets likely to be stable with up to a 10% growth this time round. Margins are likely to be similar to the previous quarter, and again, commentary would be very important. One, in terms of what FY19 is looking like, and two, what the regulatory status of many of the plants of pharma companies are currently.
Okay. Let's get some opinion before we get to more sectors analyzed. Sanjeev, what's your take on between pharma and... Okay, let me come to oil and gas first. Would you prefer the gas stocks?
Well, yes, I think the gas utilities will report good numbers, and we've seen, ex-bonus, GAIL and all have corrected sharply. We think GAIL can show very, very strong volumes. Aside from that, IGL and Petronet, all these three should be very, very strong. On the upstream, we think ONGC and oil, along with Reliance, will show strong numbers. And for BPCL, it could be an outperforming quarter, given that GRMs could actually expand on the upside.
Okay, Sanjeev, thanks for that. Let's also get a quick view on the pharma space. Nishchal, any place to hide there?
I think the only stock out there which seems to be doing well is Biocon, if you look at from the market point of view, but we do not have it under coverage. What we like, Prashant, in that space is the healthcare sector. So we like the hospitals and we like the diagnostic space. I think pharma in itself basically has got a long way to go, basically, because the US market still continues to be reeling under pressure as far as margins and top line is concerned. And we are got most of these stocks basically on a hold, and we are recommending funds to refrain from buying the pharma sector per se.
Okay. Guys, let me cheer you all up from this illness and wellness space and pharma companies not doing well. Here's one sector whose financial health is beyond question, NBFCs. Abhishek, tell us what to expect.
Amongst the NBFC space, especially in the gold finance, now GST and demonetization is behind us. So expect a modest loan growth and profit growth for both Manappuram and Muthoot Finance. In the consumer and two-wheeler, the sector has done well, so that should augur well for both Bajaj Finance and Shriram City Union Finance. In the housing finance sector, owing to increase in competition, you could see moderation in growth and net interest margin to also come under pressure owing to rise in the cost of funds. In the MFI and small banks, now rural market has really done well, so that should aid in all of the MFI players reporting good, strong set of numbers. However, the customer acquisition will be a key focus area to watch out. In the vehicle finance, strong CV sales have been seen in Q4 FY18 amongst the manufacturers. So you could see growth in CV vehicle financiers like Shriram Transport, Chola, Sundaram, etc. Now, one thing to watch out will be the 90 days transition for Shriram Transport, wherein the gross NPA will now be qualified under 90 days as against 120 days earlier. Back to you.
Okay. Time was when NBFC was an afterthought in the banking space, but now NBFC is a rich sector with consumer finance, home finance, wealth management, insurance, mutual funds, what have you. Gautam, your pick.
Yeah, so as I mentioned at the beginning, this is a sector which has been very consistent. Of late, there has been some scare because when bond yields shot up, people were worried about the elevated valuations. But now that bond yields have softened again, there is some cheer back. And growth continues to remain extremely strong and consistent and across the board. So whether it is Shriram Transport or Chola or HDFC or a Bajaj Finance, everybody is growing upwards of 25%. Of course, HDFC is growing at 13-14%, but rest of the pack is growing upwards of 25-30%. So I think valuations can stay elevated there as long as the growth visibility is there. Our preference lies with Shriram Transport, which we have not changed. We've just introduced Bajaj Finance in our portfolio, and HDFC stays in our model portfolio. I think this is going to be another star sector of this season, along with auto and metals.
Okay, if it's a star, then we'll take opinions from the other two as well very quickly. Nishchal, you still think there is a scope for price movement in this space, or is it well priced?
I think the stocks have corrected quite a bit, Lata, in the last quarter. And most of the stocks have come given away the froth basically, and I think there is a good scope given that most of these companies are likely to do 25 to 30% kind of growth. And there are two factors which are helping them. One is obviously the PSU banks seem to have vacated the space. That is driving the growth. And again, in the case of real estate also, I think that's another space where most of the developers are looking for financing, given that they are afraid for any reason they will be pulled into NCLT and they may lose the project altogether. So I think these are two spaces which is helping the NBFC, and we continue to like the whole space and housing finance in particular in that.
Okay. Sanjeev, you are the closest follower of the NBFC space. What should you watch out?
Yeah, so Lata, we think that the price correction was an excellent point to get in. For us, Shriram Transport continues to be the best play on the CV cycle. Mahindra would be an added beneficiary of Mahindra itself, the parent company, doing extremely well on the tractor front. Ujjivan will be a dark horse in the microfinance space, given that the double whammy of demonetization and farm waiver would be off. And of course, the dark horse has really been LIC housing. We think the worst of the NIM and asset quality could be behind us. That, along with Bajaj Finance and DHFL, could surprise on the mortgage front. Okay, super strong space and strong results expected. Okay, we'll move on to one of the core sectors now, cement. Utilizations apparently are at 5-year highs. Volumes will be strong, but the sector isn't expected to do too well. Nigel is standing by with some details. Nigel.
Well, some brokerages like Edelweiss are expecting a bit of a disappointment from the cement space on a year-on-year basis. That's because cement prices didn't really live up to expectations, given that it's the best quarter, while input costs did spike up. So that's what could impact the profitability in the past quarter. Well, focusing on certain stocks, UltraTech Cement, we're expecting a sharper growth over there. That's on the back of consolidation of JPA's assets. So that's what helps volumes, but impacts the EBITDA per ton. Well, Ambuja Cements, that's going to be reporting numbers on a low base. Volume growth of only around 5% because certain parts of West India, over there, in fact, demand was impacted. But profitability as well as EBITDA per ton will improve on a small base. Shree Cement will see some volume growth. That's because of capacities coming on stream. And despite the fact that we are seeing that input costs will spike up, Edelweiss expects the EBITDA per ton to jump up by more than 10%. Edelweiss says that the past quarter could be more or less a subdued one, but going ahead, they're optimistic on demand picking up owing to election year. They also believe that the sand availability issues should get sorted out.
Nishchal, what is your view? Cement?
So I think this quarter, as Nigel was putting out there, basically has been a disappointing quarter because you had volumes coming up, but the prices couldn't they couldn't hold on to the prices, and the input cost was going up. So you're going to see profitability getting impacted. But going ahead, what we've seen in both in South as well as in North, basically that the cement, the sand issues are getting sorted out, especially in Tamil Nadu and in Uttar Pradesh. So these are two big consumption areas, and prices have also gone up and the prices are sustaining. So we see that the coming quarters is going to be good for cement, and we have seen this kind of record orders being put out basically as far as infrastructure is concerned. So if you put 2 and 2 together, I think good times should be ahead for cement sector.
Okay. Gautam, any thoughts? Cement?
I think cement is that sector where macros always looked beautiful, but the execution on micro front has been, very subpar, and I think that story continues. Sometimes it is because of lack of pricing, sometimes it's because of higher costs, but the fact remains that for the last 4 or 5 years we've not seen any meaningful earnings out there. But as things improve on the capacity utilization front and infrastructure and road building continues, there can be some better times out there. We like Shree Cement in that space. We've introduced that in our model portfolio. The recent correction did provide a good buying opportunity, but this quarter should be a kind of forgetful quarter.
Okay.
We are taking stock of what lies ahead of us in terms of the result season. Nischal Maheshwari, Gautam Dugad and Sanjeev Bhasin have been answering your questions on a variety of sectors. We have Nigel D'Souza, who's now joining in with essentially what we can expect from the metals space. Steel has especially been a very strong theme. Results for the entire space, ferrous, non-ferrous, are expected to be super strong. Nigel, what can we expect?
Well, from the metals pack, let's focus on the ferrous space first. Now, from the ferrous pack, we have JSPL as well as SAIL. Those volumes will look very, very good on the back of capacities that have come on stream. For Tata Steel, there was a bit of a shutdown, so their Kalinganagar unit did have a shutdown. That's what's going to affect their volumes over there. Though Citi as well as Morgan Stanley, they are very, very confident in terms of the EBITDA per ton expanding. They say that, in fact, the price increases of around 3,000 to around 4,000 rupees on a per ton basis, that's more than going to offset any kind of input costs that have spiked up. From the non-ferrous space for Hindalco, realizations will be good, both in the aluminium as well as in the copper segment. The copper volumes should be a bit of a dampener. Input costs have spiked up, so that's what could hurt the profitability. But PAT will get a boost because interest costs are likely to dip. Watch out for a very good set of numbers coming in from NALCO because alumina prices have gone through the roof.
Oh, well, gone through the roof. That reminds me, let's do realty as well and then go to our guest. Sonal, what do you expect from the real estate stocks? As well, if you can add a bit of media and liquor.
Well, for the real estate sector, we are expecting a weak quarter again because of low availability of credit, weaker demand, and also because companies have given a lot of discounts and have sold the inventory at lower prices. Expect Sobha to give a strong quarter because of stronger pre-sales and some traction in the DLF sales. Talking about the media companies, well, 13 to 14% ad revenue growth is what is expected overall, but that sort of ad revenue growth is not expected in the print companies. For multiplexes, we are expecting strong growth in revenues this time around because of release of Padmavat. In terms of liquor stocks, not so strong for USL this time around, expecting a 9% decline in volumes because of the franchising impact, but looks very good for United Breweries. We're expecting 12% volume growth and 8% growth in realization per case. That is because of the low base that they're working with and also because of upstocking in Maharashtra. So looks good this time around for United Breweries.
Wow, that was super to finish 3 sectors in what, 1.5 minutes, Sonal. Let's start with Nischal. Nischal, anything in realty you want us to be alert to?
So I think in case of real estate, I think a very interesting thing is happening. What we have been expecting that post GST, the movement from the unorganized to organized is going to happen. I think in case of real estate, you are seeing that kind of a shift happening. Now, obviously, RERA is also helping. So we are seeing that the unorganized guys, so people who had 1 or 2 projects, those people are getting squeezed out. Those developers are getting squeezed out, and the likes of the big names like Godrej, Lodha and all, basically, I think they are gaining on their pretense. So we are continue to seeing that strong players continue to show strong growth, whereas if you look at an overall basis, I think real estate space is slowing down definitely. So I think this transition is happening in the real estate space, and I think that's going to impact the current quarter.
Okay. Let's get to Gautam. Gautam, what would your thoughts be on the metal space?
So metals, I think this quarter is going to have another strong performance across the board again. But I think what we also need to remember in metals case is last 4 quarters they've had triple-digit earnings growth. This quarter they will have 30%. So growth moderation has set in. Our view has been very cautious on metals. We do believe that one should have booked profits. That's been our view since October, and we don't see any reason right now to change that view.
Okay.
Well, the numbers will look good. The large part of the rally is behind us.
Okay, Gautam, thanks for that. Let's now go on to the power sector. What can we expect from that space? And also the consumer durables space. Anisha tracks both those sectors. So let's get a quick preview on those sectors. Anisha, over to you.
Well, we have been talking about the spot prices for power companies going higher given the increased demand, and now we know that the consumption is expected to grow by around 6% in the Q4. The PLF of the coal-fired plants also went up by 180 basis points, close to around 63% mark. In terms of stock-specific action, we expect NTPC to register 9% volume growth and a profit growth of around 5%. Power Grid has had a strong capitalization in the last 3-4 quarters. Expect the run rate to continue. 7,000 to 9,000 crores is what we expect this quarter, and a profit growth of around 20-25%, steady as steady can be. As far as the consumer durable space is concerned, the early onset of summer as well as the demand recovery trend is expected to play out for the companies this time around. For example, for Voltas, we are working with a 15 to 20% growth, and that is what we are expecting for the entire sector as well. Back to you.
Okay, and back to not me but Reema, tell us about telecom.
Telecom has been the worst performing sector in the last few months. Revenues are expected to decline for the 7th straight quarter. In fact, Citi says revenues could be down a third compared to the Q1 FY17 peak. The key reasons been Jio turned aggressive in the month of January, as a result of which most of them cut the pricing of their data packs. So that will hurt. And secondly, the termination cost for international calls was also cut. Kotak expects Bharti to post a loss for the first time in the last 15 years. Idea is likely to post its 6th consecutive loss, while Bharti Infratel could also have a soft quarter because many of the smaller operators exited, so as a result of which they will face a tenancy loss. Some of the key commentary to watch will be merger details between Idea and Vodafone, is there traction in the Jio feature phone, and the outlook on pricing from here on.
Sanjeev, let's just tackle the power space first. I mean, you like anything there?
Yeah, so I think it will be good numbers from NTPC and Power Grid, both on the volume front. Maybe the margins be a little bit under pressure. But, you know, as a dark horse, we think that most of the weakness in the power finances may have played through. And if we do get some relief from RBI on the one-day provisioning, I think PFC, REC at 7.5% dividend yield at these prices offer a good opportunity, you know, in the short run for a trading stroke pullback rally, because we think too much of weakness has been done and too much of pessimism, which is being addressed as far as coal supplies and as far as the PPA agreements, which is very much on the cards to get a strong foothold in the next few months.
Yes, power has never looked so powerless actually. But Gautam, sorry, Nishchal, consumer durables. I mean, it's a large number, but what would you like?
So I think consumer durables, given that there is a hot season around the corner basically, and we are feeling the hotness as far as Mumbai is also concerned. We like the space, the AC space out there. Voltas is one of our top picks. And again, Havells remains to be an old favorite. But I think those are the two stocks basically which we like in consumer space.
Gautam, you know, since we're wrapping up, I want to give you the last word. Any specific stocks where you think, you know, one can be pleasantly surprised based on what you expect, and you know, you get a sense that company results can be much better across sectors?
I think,
yeah,
I think one needs to watch out the rural consumption themes very closely, because the commentaries from that part of the sector, whether it is auto, NBFC, consumer discretionary, has been quite strong. And it so happens that when you are used to a certain set of percentage growth rates or a certain band of a percentage growth rate, and when things change incrementally at a margin, you tend to, you know, underestimate that. So I would not be very surprised if you see a very significant outperformance from that segment of the market. Rural consumption theme.
Okay. So then a similar last question to you, Sanjeev. If we have to expect the unexpected, what will that unexpected be?
So like I said, Lata, you know, the beaten down and the, you know, biggest underperformers could be the outperformers. given that the construction space and the road building space. So like I mentioned, you know, the likes of Dilip Buildcon, Sadbhav Engineering, NBCC, L&T over there, or the core sector, you know, real estate gainers, where market share is getting fastly, you know, passed on to the larger players, where Godrej and Shobha Developers. And thirdly, you know, Thermax, where again the industrial boiler side is doing extremely well on the profit side. So I would say this quarter will be earmarking their profitability, and execution would be the game point, you know, whether it's this quarter or the next. But that would be the green shoots which you are looking out for going forward.
And winding up comments from you, Nischal, the unexpected?
I think engineering and capital goods.
Okay.
So recently I've been meeting a lot of companies, and one very interesting thing, they are saying that they have their order books full, and whether these are the compressor companies or the likes of Thermax and everybody else, they have been very, very strong about the capex, and not this capex is not only coming from the government, but industries like cement, steel, food processing. So it seems that the private sector has also started coming into the capex. So I think that should be one sector to look out for, not only for this quarter, but for the next several quarters.
Okay, Nischal, thanks very much for your time. Gautam, appreciate you coming here. As always, with your insights. Sanjeev, thanks indeed for staying with us over the last hour.
And this quarter may be that quarter when we may, after all, get a double-digit earnings growth. Thanks very much for watching Water Se Quarter Tak.